Oh, there it goes. Okay. So now can you guys hear me and see me? We're having some technical issues. Let me try to, whoops. Okay, so Hedgehog says yes. Mike says yes. Redman, yes. Emil, yes. Okay, 10-4. Okay, good. Jane. So you guys can hear the audio and the visual working well. Isaac, thank you very much. Okay. Looks like we should be good to go. It looks there's just kind of a lag here on on StreamYard for some reason. So anyway, let me just talk to Sebastian here to make sure. Sebastian, we got things set up here. Yep. I know everything's telling me everyone's telling me in the stream it looks good, but we're good. Okay, thanks. All right. Behind the scenes there, I still got my phone cord plugged in. Calling Sebastian, making sure all the technical stuff works. Okay, sorry about that, guys. We should be good to go. So a little bit of housekeeping before we go into the super chats and the live streams. If you guys have a question you want me to make sure I focus on and see right away, do a super chat, and Sebastian will put that right up on the screen here with StreamYard, and I'll be able to address that directly. I will do my best to give you a fantastic answer. And as far as the housekeeping, I have had quite literally thousands of people since I started the YouTube channel maybe 8 months ago ask me for some sort of George Gammon type of digital product to help them become better investors. And I thought it was a great idea, but I just didn't have time. Just didn't have time to do it. That has changed. So I've been partnering with a couple people that are absolutely fantastic. You guys are going to love them. And in about 2 weeks, maybe 2-3 weeks, we're going to be coming out with a digital product called Rebel Capitalist Pro. And the Rebel Capitalist Pro is going to have research from Lynn Alden. It's also going to have research from Chris McIntosh. It's going to be an online community. It's also going to be live webinars or live streams with myself, Lynn, myself, and Chris, where we go over their research for the month, and we also answer your questions. So I won't go into great detail here on the live stream, but make sure you stay tuned for that. I think everyone is absolutely going to love it. It's going to be at a very reasonable price point. So just stay tuned for that, probably in the next couple weeks. All right, let's go ahead and dive right into the super chats. Sebastian, have you got anything for me? Okay, cool. Tappy Up B. Okay. Thank you for the super chat, first and foremost. What's the Ecuador economy real estate in 2 to 5 years? Well, actually, this is something I think about occasionally, because I don't know if you guys know this, but I own a decent amount of property in Ecuador. I own beachfront property in a place called Montanita in Olón. And it's on this 8-mile stretch of beach. It's gorgeous, a lot like Malibu in California. But so what you have to look at first and foremost is the economic environment in Ecuador. And I think this president that they have, not that he's great, but he was a heck of a lot better than I thought he would be when he got elected. I thought he was going to be a disaster. I thought he was going to be worse than Correa. But it depends on the economic stability there. And then I also think it really depends on the dollar. So if we go back to dollar, call it 70 on the DXY or 75, I think, let's just say that we were to go down to that level in 2 years, then the 2 to 5 year horizon for real estate in Ecuador, I see it being very good. Now, of course, they're really struggling with the cerveza sickness right now, but we're not talking about short term. So I think that especially when you're looking at the 3-5 year time horizon, it really depends on the dollar. And especially if you're buying real estate like on the coast or Cuenca or any of these or Salinas expat areas. So because a lot of the money that comes down there is coming from Canada, coming from Australia, and coming from Europe. So although they're on the dollar, if you get the dollar down at 70, you're going to have a lot more purchasing power for those Canadians that want it, that not only are going down to Ecuador to increase their purchasing power in retirement, but also then have a lot of, call it disposable purchasing power because of the exchange rate. So that's really what I'd look at: political stability, economic stability, then where the dollar is on the DXY. Okay, next question. Okay, same individual. Thank you for the super chat. 43. Okay. With new family in Seattle. All right. How to invest 500. That's a tough question. But let me tell you what I would do. I separate my portfolio into 3 categories. We've got insurance, investments, and speculation. The insurance is 10%. That would be physical gold. The 80%, which is investment, that would have to pay me to own it. And then we've got the 10% speculation. Now, keep in mind, this is outside of the cash you have for dry powder. This is just what you have investable right now. So if you have 500, let's say you might be comfortable only investing maybe 300 of it, or putting 300 of it to work because you want 200 in dry powder. So that's really an individual question that you have to answer yourself. But for the portion of your portfolio that you want invested, let's say it was 300. I do 30,000 gold. I do 30,000 in speculations. What are great speculations right now? I think silver is a great speculation. I think Bitcoin's a good speculation. I think the silver miners, I think the gold miners are good speculations. Especially if they come down a little bit, if we have a retest of the lows in the S&P due to another round of the cerveza sickness, if those miners go back down, it could be another good opportunity to buy. But I think uranium is a great speculation. Coal is interesting because it's a good speculation, but it's also, it pays you a lot to own it. So it's kind of a neat combination of both. So that's where I'd look. And then with the 80% investable, or that's allocated to investments, which would have to pay you to own them. So there you're going to look at dividend stocks, you're going to look at real estate. I wouldn't suggest diving right into either right now. I would suggest just putting them on your watch list. As most of you know, I'm a big fan of going into linear markets in the United States where the prices don't have the tendency to just wildly fluctuate up and down, such as a Kansas City, Little Rock, Arkansas, a Nashville, Tennessee. And I like buying there as long as your cash flow is really strong, like a 1% RV ratio. And then you can get that on cheap fixed rate debt. So 30-year mortgage fixed rate, call it at 3.5, 4, even 4.5. That's still cheap. I like that play. That doesn't mean that I'd run out and do it right now, because I think we could, obviously, as if you look at the United States as a whole, it's in a massive real estate bubble. So everything's a function of price. If you somehow are able to find a super motivated seller in a great area, linear market, where you can get a 2012 price, of course you should buy right now. But that might be hard to do. And I think that prices over the next 5-10 years, adjusted for inflation especially, will most likely go down to their historic average, which is right around the prices we saw in, call it, late 90s, 2000, or 2012. So, and if you're in Seattle, I mean, the very first thing I do is go to Hartman's website. My buddy Jason Hartman, he is an absolute pro in real estate. I know a lot, but he takes it to a whole different level. And again, I'd be patient. I think my advice is to look at the markets where Jason is and browse his website. Go to his podcast. It's called the Creating Wealth Show, and he's got over 1,000 episodes. He's been doing it since 2006. It's just a wealth of real estate information. But let the market come to you. I think that's what we need to look at right now with the investment side. That's at least what I'm doing. I'm just looking at a lot of dividend stocks that I have on my watch list, and a lot of areas for real estate out in and outside of the United States. Right now, I'm looking at a lot of stuff outside the United States, but I'm not aggressively going out and saying, I got to buy. I'm just waiting, being patient, observing, doing comps, and hopefully just letting the market come to me. And so that's probably the best advice. It's not investment advice for you. It's just what I would do if I was in your situation with the little amount of information I have to go on. All right, next question, please. Tyler, thank you for the super chat. Millennials unable to buy homes and boomers wanting to sell. As Danielle DiMartino Booth stated, wouldn't this be a huge bull argument for owning rentals in the future, assuming positive cash flow? Well, Tyler, again, I'm gonna assume that you're kind of going in the linear markets and you're following the advice I've given on countless live streams and videos before. We're gonna make that assumption, and we're gonna assume that you got fixed rate debt. Let's see. So millennials unable to buy, home prices coming down. Let's go back and look at 2008, Tyler. Actually, let's take it a step further. Let's go back to 2006. That was pretty much the peak in our last real estate cycle in the United States. So the market gradually went down in real terms, adjusted for inflation. And again, I don't, especially if you're a millennial, Tyler, I know there's a lot of millennials on YouTube that are really, really popular. And I've got a ton of respect for these individuals, but they have the tendency when they're looking at charts and historic prices to look at them in nominal terms. And if you look at a nominal chart of United States housing, it looks pretty darn good. Yes, it kind of comes down, but the lows are always higher. But then when you look at it inflation adjusted, you're like, wait a minute, this looks a lot different. And I would assume that your goal in investing is to increase your actual purchasing power, in which case you'd want to focus on those inflation adjusted charts. But if we go back to 2006, then we see this downward until we get to 2012, where it bottoms out at its historic trend line going back to 1900. So you had this 6-year downtrend in housing prices. What happened to rents during that time? Well, rents over the span of those 6 years actually went up. So there is an argument, to your point, where if people can't afford to buy homes, you're going to have more renters. And then even if the prices of homes collapse, you've got fewer people that can actually buy, or fewer people that want to buy. And I know that sounds weird right now because we're in a very hot real estate market. So you say to yourself, well, why on earth would someone not want to buy if prices went down? You've got to adjust your psychology, right? And what I mean by that is back in 2012, when I got into real estate, when I retired, I was buying properties right and left. I went almost all in, 100% of my net worth in real estate. And I wouldn't suggest anyone doing that now, but I didn't know any better back then. So I was all in with real estate in 2012. Everybody, and I mean everybody, was telling me that I was a lunatic. I was crazy. George, what are you doing buying real estate right now? It's done nothing but go down for the last 6 years. It's never going to recover. Why are you buying that? That's the worst asset class you should go into, or that's the worst asset class. You're never going to make money with real estate. The banks are giving houses away. They're trying to get them off their balance sheet. There's short sales everywhere. There's foreclosures. People can't pay their property taxes. The unemployment rate is up at, call it 10% or whatever. Don't you know any better, George? See, this is what you have to deal with when prices go down. And that's why it's so hard for people to actually buy at a bottom or close to a bottom. You never want to time it, but that's why it's so hard to buy low and sell high. We hear that since we were kids. You buy low, sell high, buy low, sell high. Okay, well, why can no one do that? Because when prices are actually low, psychologically, it's very difficult to pull the trigger because we have recency bias as human beings. So we think that whatever has happened over the past 2 years, especially if it's happened over the last 5 years, it will happen for the next 100 years. That's just how we're hardwired. So it's that. My point is that's what you've got to consider all these factors when you're trying to figure out what rents are going to do and then what prices are going to do. So my point, I guess my main point, is that you could see rents go up. In my opinion, if you see a long extended type of depression, and keep in mind, we can have an inflationary depression. It doesn't have to be a deflationary depression. Going back to Chris Cole's paper, Allegory of the Hawk and the Serpent, we know that hawk cycle, if you want to look at it that way, has a left wing of deflation, but it also has a right wing of inflation, where you have a debt deleveraging as a result of people just not paying the debts, i.e. 1930s. And then, or you just have a devaluation of the currency where the debt is wiped out like the 1970s. So there's two ways that you can have that depression. I want to make sure that people realize that. So if you have just a 2-year type of thing or a 3-year type thing, I think that might be rent positive. I think that might be a tailwind. I'm not saying rents would go up, but I'm saying it could be a tailwind. If you go into like a 5-year, 10-year thing, like we had in the 1930s, where, and by the way, in the 1930s, the Depression wasn't just deflationary. It was only deflationary until 1934. If you look at the charts, 1935 to 1940, it was actually inflationary. Most people don't realize that, but anyway, I won't go into that. So if you've got this long-term extended depression, then I think people will start to change their behavioral patterns, and I think you'll have more people moving in so you have more people per square foot of rental property, in which case you could see downward pressure on rents then. But then you have to ask yourself, compared to what? And if you go through that type of scenario, compared to the prices of other things, especially assets, your cash flow would probably be going down a lot less, just like your gold. So I know that's not a definitive answer, Tyler. I apologize, but that's just me thinking through out loud your question, and hopefully that gives you some good ammunition to come to your own conclusions. All right. Next question, please. Ike, thank you for the super chat. Would it be good to save money and wait for housing to collapse like it inevitably will? Buy $100,000 that are really worth 40 is always a mistake. Cash flow, right? But it's, again, Ike, it's a function of price. And you have to understand that the real estate market is wildly inefficient. It's not like the gold market or the oil market. So let me give you a specific example. Let's say that gold right now is trading for, just call it $1,800 an ounce. You can't find anyone, or it would be very hard to find someone that would sell you a gold coin or gold bar for $900 an ounce. Why would anyone do that when they can just, the very next day or immediately they can trade it or do whatever for 1,800 an ounce. It's a very efficient market. The same thing with stocks. The same thing with oil. Real estate isn't that way. If you've got a $100,000 house, or the prices of homes in this neighborhood, let's say, are $100,000, if you know what you're doing, and if you're patient, and if you're a heck of a negotiator, you might be able to get a house in that neighborhood for 50 grand. And you say, why, George? That doesn't make any sense. Why would they sell to me for 50 when they could just put it on the MLS and in 6 months or 3 months, they could sell it for 100? Because people are crazy. That's why. And I hate to just throw it out there, but that's just me calling a spade a spade. People are crazy. What you're doing is you're assuming that everyone is rational, like you are, or probably everyone on my chat stream. We're all very rational people, but you have to understand the world is comprised of people who are highly irrational. And, or let's say, they've got a drug addiction, or they've got a huge debt problem, or you never know what weird thing is going on. And although it's hard to do, you can still find these good prices if you really know what your deal. So my point is, everything is a function of price. And just because the market's at 100 right now doesn't mean that you can't buy something at the 2012 price. So why not just put your 100,000 in the bank and wait for prices to collapse? Because I'm not saying you should go out and invest right now. I am saying let the market come to you and be patient. But I'm also saying make sure you're out there snooping around for good deals, because you never know what you're going to find. And you could remember, prices may come down in real terms, but not in nominal terms. So how does that work, Ike? Let me give you an example. And I know I ran through this math with my sister the other day, because she's got a place in Dallas. And I was talking, she watched one of my real estate videos where I was talking about prices going down by 50% over the next 10 or 15 years, right? If we look at the Japan model from 1990 to 2005, their real estate prices didn't bottom out for probably 15 years. And I'm not saying that we're going to have that in the United States. I'm just using that as a model for my thought experiment with my sister. And so she's like, yeah, I watched your real estate video. I just don't see prices coming down in Texas like that. There's just no way. You've got all these people coming in from California and New York. And every time I drive down to the store, you've got the cranes, they're building. And we all know the argument for being bullish on Texas. I said, okay, would you say, because of the cerveza sickness and everything else, that there's a chance that home prices in Dallas or in Texas go down just by 5%, just 5% the next 2 years? So 5% this year, 5% the next year. She thought about it. And she said, yeah, yeah. I mean, I could see that happen. And I'm talking about in nominal terms. She's like, yeah, I could see that happening. That's probably realistic. And I said, okay, well then over the next, call it 5 years, could you see prices just staying stable, not going up, not going down in real terms? Or I'm sorry, in nominal terms. She said, yeah. I said, okay, well then do you see the next 8 years prices going up in nominal terms by 3% per year? She says, yep. I said, okay, lastly, do you think that we could have 5%, again, 5% inflation in the CPI over the next 15 years? So starting this year, every year, if you average it out over the next 15 years, we see a prices increase by 5% nationwide, just because of all the money printing, or maybe they do MMT, or I'm not going to go into those videos, but you guys know the argument there. And she said, yeah, I can see that. I won't say her name, but I said, listen, what we just outlined, home prices would go down by 50%, adjusted for inflation. And you can do the math. When we go to a mortgage calculator, go to an inflation calculator. Those are kind of what I use. Or not, I'm sorry, not a mortgage calculator, but it would be a calculator, a compound interest calculator. And then you adjust for inflation, you do all these things. And I won't go into, I don't want to go off on a tangent here, but if you do the math, you'll see that over that 15-year span, if you have prices go down by 5%, flat for 5 years, and then up 3% per year, while the inflation rate is 5% per annum, at the end of the 15 years, the value of the home in real terms goes down by 50%. Although in nominal terms, the price of the house has actually gone up. That's why I would, I'm not going to say that I wouldn't keep dry powder on the sideline to wait for homes to quote unquote collapse, but I would think that through. It's a very nuanced question, and it's not as black and white as it may seem. And I would kick tires right now. I would look and I would just do my best to try to find a smoking deal at a 2012 price so I could get that money working and I wouldn't have to worry about it being inflated away. Okay, next question. DJ, thank you for the super chat. How will we know when it's time to sell speculations like silver and mining stocks? Is there any kind of ratio you look for? I just look at their charts adjusted for inflation, going back as far as I can. So I just try to find, okay, when is this cheap? When is it expensive? If I think now we're getting to a point where it's expensive, all right, well, let's go ahead and think about selling. I remember back and this is really before I got into macro. I didn't really know anything. But remember back in 2000, was it 11, 12? Whenever gold hit its peak last, and not, what was it, 1900, 1800, something like that? I remember back then, every single mall I would go to, like all the kiosks were people who, I'll buy your gold, I'll buy your gold, I'll buy your gold. You turn on the TV, every commercial is we buy gold, we buy gold, we buy gold. You get in the Uber ride going down to the nightclub or whatever on Saturday night. And your Uber driver is talking about buying gold. It's the same thing when Bitcoin hit 20 grand or 19 grand, whatever. That's when you need to think about selling. When I think about selling, I look at it from a quantitative standpoint, looking at the data, the charts, like I said, but I really try to look at it from a human psychological point as well. And if I talk about a specific investment to all my friends and family member friends, and all of them just say how great of an idea that is. Oh yeah, all my friends are talking about that. Yeah, boy, I've been wondering how I can get into real estate. Or oh yeah, you're investing in silver? Oh yeah, all my friends are doing that. Boy, I've been seeing it on TV. In fact, the other day when I went to a mall, my gosh, I saw a bunch of stores in there for silver. Well, I got to get in on this. But man, how can I get rich as a result of silver? I'm hearing it everywhere. I turn on the radio. People are investing in silver. Boy, it's going to the moon. It's never going to stop going up in price. Probably a good time to sell. On the contrary, if all your friends and family member Fred, you say, I think I'm going to invest in some silver. Why would you invest in silver? That is the stupidest thing I have ever heard in my life. Don't you know that we're in the cerveza sickness right now and there's never going to be a bid for silver for the rest of our lives? that's dumb. Go sit in the corner and with your dunce hat on. Probably time to buy. Right? So that's I almost want to say I look at the psychological component even more than I look at the charts, but I wouldn't go that far. So that's how I would start to, not just for silver or mining stocks, knowing the time to sell, but anything, any asset class, you name it. And that's why I started selling. Well, I won't go into it, but anything I've sold in the past, and you guys know that I usually never sell anything. But the few things that I have sold, other than flips, I sell when I have my team in Medellin go in and remodel a property and then sell it for a quick profit. But that's not really an investment. That's kind of like a small business thing. But any of my core investments, I never sell them unless I see this stuff going on, and then yeah, go ahead and sell. All right, so I guess we've got a lot of super chats. So Sebastian is saying, please no more super chats, guys. Just FYI, just because I try to keep these things to about an hour and a half or so, and just so I can get lunch and work on tomorrow's video. And and by the way, I'll go ahead and tease tomorrow's video while I'm at it. I think it's going to be interesting. I don't know if it'll get a lot of views. I always have to kind of go back and forth as to, because if I just strictly went for views, I could get a lot more, but the content just wouldn't be as, I don't want to say thorough. I want to say it wouldn't be as intellectually curious, would be the best way to put it. And so I try to do a mix, but so tomorrow's video probably won't get too many views, but I think it's something that the people who really enjoy that stuff will enjoy a lot. So what I'm doing is I'm thinking through how negative interest rates could actually create a dollar hyper bubble. So not a dollar crash, but a dollar hyper bubble. And I'm not. This is not a prediction. This is not a prediction. Just I'm thinking through how that may happen, so you guys can start putting that on your radar and thinking through it yourself. So that's probably going to be tomorrow's video. But anyway, all right, Sebastian, next question, please. Jonathan, thank you for the super chat. How will deflation or inflation affect the average person's wages in the real economy? Will they go up during inflation, down during deflation, or will companies be able to raise wages? This is a really good question, Jonathan. Unfortunately, if we look at history, we see that even if wages go up during a time of inflation, they typically lag prices, so your purchasing power goes down. During deflation, see, the deflation that's a tough answer, Jonathan, because I don't see a probable scenario where consumer prices, let me be clear, consumer prices go down for an extended period of time. Granted, they definitely can go down for 6 months or a year. But can prices go down in the United States based on our current regulatory environment for 5 years? I don't think so. And it goes back to my analysis of the 1930s, if you watch that video, where we see inflation in the latter stages of the 1930s. And my argument there, my hypothesis, and it's definitely not I don't want to confuse correlation with causation, but my hypothesis is because we had unemployment benefits and Social Security come out in 1934, 35. And I know they didn't get the payments till later, but that's when I think it went into law. And in 1938, if my memory serves me, we had the minimum wage law. So why is that a big deal? So because now when the economy goes into a recession or a downturn, it's extremely hard for businesses to lower their wages. It's hard in nominal terms. So before the 1930s, that was easy, super easy to do. And you didn't really have a transfer mechanism for government spending getting directly into the back pockets of the individuals who would spend it at velocity. So, but then they have the unemployment, they have Social Security. Now you have these and I'm not saying they're good or bad. I'm just analyzing it as a I don't want to say an economist, but using common sense, let's just say that. So you've got the money going into the back pockets through unemployment and Social Security. So that's creating demand that otherwise wouldn't be there for your basic necessities during a time frame of a deleveraging. Then you have businesses that really can't lower prices. And I know a lot of businesses, you say, well, George, not every business has just minimum wage. Right, but the minimum wage really trickles up through the all the supply chains. So it's tough for them to really kind of lower their prices, or I'm sorry, lower their wages. So then you have more businesses go out of business. So the unemployment rate would go up faster. And then the supply of goods and services would decrease a lot faster. So although you have a destruction of the demand side of the equation in a deleveraging, whether it's inflationary or deflationary, you also have, or potentially, the supply side of the equation going down a lot faster. So even if they're both going down, if the supply side is going down faster, you're still going to have prices increase, consumer prices in the real economy. So unfortunately, even if we go into, and I'm not, well, let's call it a deleveraging, what starts off as a deflationary deleveraging, let's say for the first year, but then prices start to go back up for the reasons I'm talking about on the supply side. And that equate, so you might not see a decrease in wages in nominal terms, Jonathan, but you'll, over the long run, you would most likely see a decrease in wages in real terms, adjusted for inflation, in either situation long term, and you would see a much higher unemployment rate, because although wages may be artificially high, and again, I'm not saying that's right or wrong, it just is, that more businesses would go bust, and therefore the unemployment rate would go up. So that's a great question. Really, really cool question. In fact, that would be a good topic for a whiteboard video, really, because it's so important, Jonathan, to your point. I mean, this affects everybody. But it's also very complex and very nuanced. And we as people, we just like simple answers. But unfortunately, sometimes the simple answers are incorrect, or at least they're not taking into consideration the nuance that's required to use the information to actually make financial decisions. So anyway, thank you for asking that question. Great question. All right, Sebastian, next. Ian, thank you for the super chat. When will gold reach 2,000 an ounce? Oh, I don't know, Ian. You're asking the wrong guy. You can't make predictions like that and know when something's going to happen. What I can tell you is I think the probability of gold reaching $2,000 an ounce, let's call it within the next 2 years, is high. I would peg it right off the top of my head at, it's got to be 85%, 85, maybe more. I just, it's not a prediction, but boy, I mean, can you envision what would, you got to take the other side of the argument. What would prevent gold prices from going to 2000 over the next 2 years? I don't know. If we had a completely free market where the Fed wasn't intervening in repo, and that ain't going to happen, I could maybe see that happening because you'd have natural deflation. The actual prices would go down, but that would be if we had no minimum wage, we had no free. That wouldn't exist in the world, at least the United States, the way it's set up now. I don't know. Because the only reason I can think of gold not going to 2000 is if people have liquidity need, big entities have the need for liquidity. And so they have to sell, they need collateral for their dollar funding needs. Well, the collateral they have may be illiquid, and therefore they've got those dollar funding needs, and therefore they have to sell anything on their balance sheet. So, or anything that's liquid, which would most likely be gold. But I don't see that playing out. That's like something that happens over 6 months or over a year. Generally, the powers that be come in and try to solve the problem. Of course, that makes it worse. But over the short term, that keeps the large entities from having to sell their gold to get the liquidity they need. And therefore, you see fundamentals start taking over. And because the Fed or the government creates so much money supply on they call it base money, and then the government, if they spend that into it, then your fundamentals, then the market says, okay, we don't need the liquidity anymore, so we don't have to sell the gold. And look at what the Fed's doing. Look at what the government's doing. Now we've got to buy all that gold back, and you see it going up. This is exactly what happened in 2008. If you look at the charts, especially the charts compared to the repo market, and the repo fails. So yeah, I would say, I mean, 85, 90% that it'll be at 2000. But Ian, now I'm going to agree with you there, because I'm assuming you're a gold investor. Now I'm going to burst your bubble to a certain degree, because I'm a huge fan of gold. I suggest obviously everyone having 10% of it of the portfolio. But what if gold only goes up in nominal terms to 2000? And if you sell, all of a sudden you got to take a tax hit, which means that after you end up selling, you're putting 1,800 an ounce in your pocket. You're actually losing purchasing power. Wah, wah, wah. You know? And I'm not saying that's going to happen, but you have to, as a gold investor, I think we need to be cognizant of that. Going back to the probabilities, I think that gold will outpace inflation, but it's definitely something we need to think through. It's not, I see a lot of people investing in gold saying, oh, it's going to go to 10,000 an ounce, and if it does, I'm going to be rich. Maybe not. Maybe not. You won't be rich if it just goes up with inflation and you got to sell it and take a tax hit of 20 or 30%. Especially if let's think this through. As you guys know from watching my videos, I'm a firm believer that taxes are going up in the next 5-10 years. I don't see how we avoid that. Well, it might not be the income tax, but a wealth tax. It'll be a precious metals tax. It'll be a capital gains tax. Capital gains will most likely go to income. It'll be property taxes, a VAT, sales tax. There's just, if you look at what's happening in the world right now, especially in the United States and the developed economies, with their debt and their deficit spending, I just don't see how we can avoid higher taxes. So that, if your gold goes to 10,000, 50,000 an ounce, but just goes up in nominal terms, and in order to realize the gain, you've got to sell and take the tax hit. It's tough. And again, I don't want to burst your bubble, and I'm the biggest proponent of owning gold out there. I just don't know if you're going to get rich owning gold, although you might. I think it's a good, I think you you might, but you also may just maintain your purchasing power. I think whoever said it, you don't get rich with gold, you stay rich with gold. I think there's something to be said for that. Okay, next question. Abby, thank you for the super chat. Discuss shorts. Millennial blowing their unemployment checks on Robinhood's account. Oh, yeah. Yeah, I see this. A lot of the guys that I watch on YouTube, just because they're so amazing at YouTube, just to try to work on improving my own videos, are in this category. Yeah, and unfortunately, they just get millions and millions of views, and this is what they. I'm not going to say they suggest this, but I think this is most of the people watching their videos. This is the takeaway. So anyway, millennials blowing their unemployment checks on Robinhood accounts. Don't mind selling stock I don't own. When will they crash? I'll get their money. Think on this. Do a video. Yeah, Abby, I'm not sure I'd short though. I don't know, Abby. For it, you could be really good at it, and so I don't want to give individual investment advice. For me personally though, I don't like to short the market because I mean the Fed comes in, who knows what they'll do? They buy ETFs, who knows if they'll buy stocks directly. And I know Jeff Snyder would argue they can't prop up the market. They can't physically prop up the market through creating additional bank reserves. But from a psychological point, if they convince everybody that there is a Fed put and people buy and go further, take their, let's call it UBI checks moving forward and just go straight into Robinhood, who knows what the market could do. And it could decrease in real terms, but still go up in nominal terms. I think if it were me, what I would prefer to do is if I was going to short, I would make sure I've got some longs in there. So now it's tough to find longs. If you wanted to short, let's say Uber or just any of those companies like out there that don't make any money, because the millennials are going, I hate to pick on them, but they're going in and buying those stocks with their accounts. I would make, okay. So let me give you a good example of what I'm talking about. And this is, I have not done this, but I've thought about doing it. All of the Robinhood folks are buying, or did, when oil dropped, they're buy the dip, buy the dip, buy the dip, buy the dip. And they bought USO. What most of them don't know is that USO doesn't own any underlying gold. They own the futures. And we know as people who are watching my videos, if you own the futures and you've got to continually roll those contracts over, when the oil curve is in the term structure is in contango, meaning the prices today are lower than next month. And so, it's kind of going up like this. Then as they have to roll those prices over, typically you're going to have a negative carry. So over time, USO almost has to lose money. You could have temporary spikes and whatnot, but if you hold it long term, it's going to lose money. So if you could short, or if I could, let me phrase that differently. If I could short USO, but buy something that's cheap, like maybe Shell, now all of a sudden I've got a short that's kind of taking advantage of what you're talking about, but I have a long in the exact same industry that is cheap, or that could be considered cheap. So you've got that, and then just ride it out for 10 years. and let your USO gradually go down. And they're both tied to oil to a certain degree. So you don't have too much downside risk, regardless of what the Fed does or the government. I'm not saying that's a strategy for everybody, but if you're able to structure a portfolio where you have longs and shorts, then I think maybe that there's something to that. Also, if you're a little more sophisticated, it might be a better idea to go to try to structure something that's long volatility instead, or something where you're like maybe you're expressing that through options. Might be a little bit better way to do it. And by the way, I've been talking back and forth with Patrick from Macro Voices, and we're definitely going to do a video or maybe even an instructional series on how to build a dragon portfolio for the average guy and gal, for the average Joe and Jane. It's just he's slammed right now, so it's probably going to be 3 or 4 weeks, but that's definitely in the works. So I think that's the best way I can answer that, Abby. All right. Next super chat. Jay Bishop, thank you very much. Thoughts on REITs? I like, me personally, I like managing my own investments a little bit better. If you have to go into REITs, Jay, I would make sure that I'm very cognizant of the underlying assets. So if you've got a REIT where their underlying assets are malls and strip malls, commercial, I wouldn't touch it with a 10-foot pole. If you've got REITs where their underlying asset, and I don't know if these exist, but let's say their underlying assets are nursing homes for all the baby boomers. And let's say they have a portfolio of nursing homes and like just kind of entry-level apartment complexes. I might be interested if it was cheap. Or you get a REIT of maybe, and again, I don't know if these exist, but of international real estate, maybe where the underlying asset is, but then you could have some currency risk. Well, let's just assume that you're okay with it, with the currency risk, or you're looking at it as an opportunity to diversify. And I don't even know if these products exist, but that's kind of how I'd think through it. I'd start looking at countries and then underlying assets within those countries where I like what they're doing, and then I'd say, okay, is there a REIT that would allow me to go long? You might have to have an interactive broker account. I don't know. I just know they have a lot more options when it comes to international stuff. But I think that's my best advice, Jay. Be a little cautious there, because I'm not overly optimistic on the real estate market, as you know, just little teeny certain sections of it. And see, another thing with a REIT is you're not going to be able to buy a REIT for half price. That's what I don't like about it. Where a house, because the market is so inefficient, if you find a motivated seller, you can buy a house at maybe not half, but let's call it 80% off. You can't find anyone that's going to sell you a REIT at 80% less than where it's trading right now on the whatever stock exchange. So, but I don't want to go off topic. I'm assuming you're probably asking this because you have to do it because of a 401k, IRA, something like that. So that's how I do it. I'd look at the underlying asset. I'd try to wait till it's cheap. I'd maybe consider something international. All right, Sebastian, next. E-Money, thank you for the super chat. If gold is insurance and silver is a speculation, what criteria would you look for to sell some or all of your gold, silver, or mining stocks in the future? Okay, I'm going to be pretty brief on that one, E-Money, because I answered this question earlier in the super chats or in the live stream. So if you want the more extensive answer when we get done and this is uploaded to the channel, just go ahead and watch that beginning part, because I really dive into it. But as far, I look at it from a quantitative standpoint, looking at the data, the charts going back as far as I can, adjusted for inflation, try to see when it's getting close to a high water mark and when it's close to the bottom. Of course, you've got to assume you've got to consider the M2 money supply as well, because I mean, gold is competing with money, or no, I'm not going to call it money. Gold competes with currency to a certain degree. And as far as your mining stocks, I do the exact same thing. But I would look at it from a psychological standpoint as well. How many gold kiosks do you see in the mall? How many gold commercials do you see on TV or the radio? How many of your friends and family members are buying gold or silver? If the answer is a lot, probably it's time when you should start to consider selling, especially if you look at the charts and we're getting close to a high water mark. Yep. So that's what I do. And again, E-Money, I go into that much more extensively about, what are we, 57 minutes in? Probably around the 20-minute mark of the video. So check that out when it goes live as soon as we get done here. All right, next question. Evolve23, thank you for the super chat. Saw an article about governments banning gold ownership. What do you think about the probability in Bitcoin? Mind you, it was on a Bitcoin website. Yeah, but they have a point. I've actually done a video on this. So certain countries have banned gold in the past, and oddly enough, it's the ones that claim to have the most amount of freedom, being the UK, the United States, Australia. Well, and they've confiscated gold. So I think this is a short-term, long-term question. Short-term, I would say the probability is low between now and the next 3 years. Long-term, 3 years, 5 years, 10 years plus, I don't know that the probability would be high, but it would be significant. I would say the next 3 years, 5% at the most. 10 years, 30, 40. Because if you assume that we're going to go on to a gold standard, that's going to be the end game for fiat currency, that could happen. I'm just reading your question, trying to make sure I answer it as thoroughly as I can. Yeah, I definitely think it's something to consider. So what do you do? First, you can get some jewelry, because in the research I did, they never banned jewelry. So I know it sounds ridiculous, but go out and get yourself a Mr. T necklace that's $100 grand in gold. And I know there's some companies, I think Shift deals with the company, and Mike Maloney, I think, deals with the company. I don't know if it's the same one, but they actually create jewelry that has a high percentage of gold. I would, in fact, I've actually thought about doing that myself. And because you can always just throw on your necklace and hop on the next plane, just say, peace, I'm out. And then if you got, let's say, 10 million in gold, probably not realistic to do jewelry. I would want to diversify where the gold is as far as the political jurisdiction. And I'd want to stick with areas that have no history of banning or confiscation. So Singapore, but I wouldn't want everything in Singapore. See, places like Singapore and maybe Dubai, it would be so much harder to confiscate gold there, because it's really, the society sees gold much differently than the Western world. So but I try to diversify, but I like having a lot of physical just near you as well. So those are kind of the options that I'd think through. It's having a good portion that's within a bicycle ride, let's say, jewelry, and then diversification with your storage. Political jurisdiction, political diversification. Okay, next question, please. Super Agario, thank you for the super chat. Sold half my business, netted $1 million. Good for you, man. Awesome. Good to hear that. 38 years old, 3 kids, steady income, 20 a month, ongoing last 5 years. What do I invest in or do from here? If you're in California, move. yeah, exactly. That's the very first thing I do. Holy cow, get out of Dodge. You are going to have a huge target on your back. You're successful. You're creating jobs. You got $1 million in the bank. You're making 20 G's a month. Whoo! The California government loves you. They're going to try to find you, and they're going to get their best target, and they're going to slap it right on your back. So I would get out of there. It'd be so fast it'd make your head spin. I'd get out of California. So that would be number one. Especially if you have your 20 grand or your business allows you to work remotely, then assuming that it does, I would strongly consider Puerto Rico. Got great private schools there. You're going to save a ton moving forward on taxes, even compared to Nevada, Texas, Florida. But I realize you've probably got well, you don't say that you've got a wife, but I'm assuming it might be maybe complicated for you. But if you could just wave the magic wand, I'd definitely consider Puerto Rico. Act 2022, now it's Act 60. But if you've got to stay in the U.S., just shoot over to Nevada. I mean, so many people are just moving to Reno just because you're right there on the border, close. I'd consider something like that first and foremost. But as far as I would look at my bills and try to create enough income with the investment side of my portfolio to where you could allocate any additional cash flow or money coming in per month to investing. And you don't ever have to worry about drawing against your savings. That's one thing that I did back in 2012, which if I did anything smart, that was one thing for sure. And that I looked at my own personal situation and said, okay, I didn't have any kids, don't have a wife. What do I need to per month to just maintain my lifestyle? And I was pretty much kind of in this, well, I won't go into it, but the answer for me was, call it 10, 20 grand, something like that per month. And so I said, okay, how can I build a portfolio where I have that much coming in per month? And so no matter what I do, if I spend 100% of my income that's coming in from my assets, that I never spend a penny of my savings, call it. And that's exactly what I did. So it's harder to do that now because you can't get the returns that you could get in real estate back then. But it may be possible in the future if we really have a second wave of the cerveza sickness assets go down. That's kind of how I'd start thinking about it. And then from that would be the 80% side of the portfolio. And then I'd also look at the 10% speculation, and then making sure that you've got the 10% gold. So if you got $1 million in the bank, just make sure you get 100,000 physical, because you don't want to just kind of have a quick inflationary bout of even, call it 15%, where you're losing 150 grand of your purchasing power just by not taking action. So that's why with me, I really don't look at the gold price for my personal portfolio. It's just whenever I get another 100 grand, bam, I buy 10 grand in gold. I get another 100 grand, bam, I buy 10 grand in gold. And regardless of where the price is. So I know I don't have too much risk to fiat currency. So that's how I would do it personally. And I think you're in a fantastic position. Congratulations. So just to recap here, first and foremost, I'd look at a way to move so I could get a better, I could have a better tax strategy. So maybe going over right into Reno, Nevada, or going maybe Texas, Florida, or if you've got the flexibility, definitely check out Puerto Rico. Then I would look at figuring out your monthly expenses. I'd try to figure out, even if you didn't take action right now and buy something, I would set up a game plan to how to create that. And then I just wait for the market to come to me, as far as making sure that you're paying your monthly expenses through cash flow, so you never have to draw down what you've been able to accumulate. And then I just set up the portfolio: 10 insurance, 80 investments, 10 speculation. Oh, and one other thing, and then I would 100% buy George Gammon's new product, digital product that's coming out in 2 weeks. That is right. You've got to subscribe to Rebel Capitalist Pro, Super Ajario. That's the first thing I do. Forget the tax stuff. You got to subscribe to Rebel Capitalist Pro. Shameless plug. There you go. All right, guys. Next question, please. Atlas, what islands interest you for a second home? Well, Puerto Rico, first and foremost. Well, thank you for the super chat. I'm sorry. Puerto Rico, I do think it's interesting what Raul Paul and Hugh have done, Hugh Hendry. And if you didn't see, I just addressed that briefly in a couple videos, so you might not have seen them. But, and I don't know if you're a subscriber to Real Vision, which I'd highly suggest. If you saw the interview, or it was really more of a conversation between Raul and Hugh on Real Vision a couple weeks ago, these are two macro geniuses. That's just the bottom line. So they look at everything through a lens of macro first. So to hear both of them, who have invested in real estate, but they've done so from the view of inflation, quantitative easing, volatility. They've kind of done it through the lens of the Dragon portfolio and Chris Cole's paper. And again, that's allegory of the hawk and serpent. If you haven't read it, make sure you do so. And so what they're looking at is, how can I invest in a hard asset that is scarce and use fixed rate long-term debt, which will most likely kind of be the where I'll be paying it back with cheaper currency, but a way to go long volatility. So the way Hugh did that is he set up this awesome, amazing resort in St. Bart's. The way Raul did that, if I understood their conversation correctly, is he bought a pretty big spread in Little Cayman. So why is that a hedge on volatility? Or why is that maybe even a long play on volatility? Because if you have, let's say, massive social unrest, let's just say we have a currency, a fiat currency collapse or crisis, like so many of us see long term. And that would include Brent Johnson, by the way. So many people see him for the dollar milkshake theory, and that he's very bullish on the dollar short term, seeing it going into potentially a hyper bubble. But if you look at what, or if you listen to Brent long term, 5 years, 10 years, he's saying that it's all going to, the dollar is going to totally collapse. So in that world, what does social unrest look like? And if you've studied Grant Williams or listened to his interviews, I discussed this with him on my interview with Grant. He's done a lot of work on social unrest. And usually social unrest comes as a result of either food prices going up to where people can't put food on the table anymore, or a subsidy being taken away. So as an example, in Ecuador or in Venezuela, they subsidize the gas to where it's almost free. Well, if you do that for 20 years and people build their entire lives and the entire economy around gas being free, you try to take that away, forget about it. It's going to get real ugly. There's going to be pitchforks very, very fast. Also, if we see the price of food skyrocket, same exact thing. So in this world of a fiat currency crisis, what's going to happen? Like, probably both of those things would happen. And they wouldn't just happen in places like Egypt or Chile or Venezuela or France to a certain degree. They're going to happen in the United States. It's going to happen in Japan. It's going to happen. Well, Japan would probably be an outlier just because from a cultural standpoint, that would be so atypical. But US, Australia, even Australia, Canada, I mean, this is going to be a worldwide phenomenon. Think about the volatility in the markets, the bond market, the stock market. I mean, everything is just going to be up, down, up, down. It's going to be crazy. Who knows what the world looks like? It's going to be a scary, scary time. Well, if you've got some money, you don't want anything to do with that. Trust me. I've got a little bit of money, and the last couple of weeks with the cerveza sickness, I'm getting sick and tired of being in an apartment and I love Medellin. This apartment is kind of a rental. It's a fantastic apartment. It's a gorgeous apartment. You got Carrara marble, you got wood, you got the loft look, everything. But man, I would much prefer to be on a beach in St. Bart's or in Little Cayman, let me tell you. And so that's why I think what Raul and Hugh have done is so interesting from a standpoint of volatility and going long vol, which I know they talked about. Because if you have this world of social unrest, the price, and they have a scarce resource, right? They're not selling any more land in St. Bart's, or they might be little portions, but not big chunks like Hugh bought and that he's got his big resort on. Or, same could be said for Raul. I don't know how big his spread is, but say he's got a really big spread in Little Cayman, same thing. They're not making any more of that. It's very, very scarce. So prices most likely would go up. And also, even from a cash flow standpoint, like look at Hugh's place. Like I tell you what, if I could get on a boat right now and somehow get to St. Bart's, done. I would be there in a second. And I don't care what he would charge me. I'd rent a villa at his resort just so I could get out of the darn house and just get some exercise and be on the beach, something like that. So anyway, my point. And now I'm just looked at the question again. Oh, that was a tangent right there for you. Okay, so the Cayman Islands, St. Bart's, Puerto Rico, especially for taxes, but maybe not to go long volatility. Just look at the Caribbean. Anything, those smaller islands there, maybe even St. Kitts, because then you could, depending on your financial situation, if you bought a place there, I think you qualify for their second passport program if you invest enough money. I think you got to spend like 400 grand or something like that. But that would be something interesting. And of course, that's in the Caribbean chain there. So that's probably where I'd look, Caribbean. Okay, next question. Dapper Dave, thank you for the super chat. Can you explain DiMartino's point on why debt jubilee wouldn't work? I didn't understand the point she was trying to make in your previous video. I would have to go back and watch my interview with her. I'm not quite sure when she discussed why a debt jubilee wouldn't work. I remember she talked about a debt jubilee because I had it written down in my notes when I was, let me try to think real quick here, Dave. That's right. I remember now. Because she was talking about how a debt jubilee wouldn't get into the real economy because they would be alleviating the debt and they'd be freeing up the balance sheets of the banks and the corporations. And so because because to have a debt jubilee in the real economy, you've got to look at the counterparty. So let's say you could come in and say, okay, we're alleviating all mortgage debt. You're free. We're going to free up the balance sheet for the average Joe and Jane. That would be an example of the debt jubilee. But what's the other side of the equation? Then every single person that owns the mortgages, the pension funds, the financial systems, Fannie, Freddie, who knows the systemic risk out there. But you have all of these institutions that would most likely go bust. So they can't do that. Now that you bring this up, I remember what I wrote down when I was talking to Danielle. I actually wrote down Steve Keen. I wanted to ask her about Steve Keen's proposal for a debt jubilee, Professor Steve Keen. But sometimes you just can't ask all the questions, and Danielle was kind of limited on time. And sometimes you write down questions when you're interviewing these people that you want to ask, but the conversation just kind of goes in a different direction. So you don't want to take the conversation back to where it was 10 minutes ago. So I didn't bring it up, but I'd love to get her opinion on Steve Keen's take. So what is Steve Keen's take? He proposes a debt jubilee where you give every American, let's say, $10,000, bam, just like that, or 20 or 50 or whatever, with the stipulation. And I don't know how he would implement this, but assuming that it could be done, that first and foremost, they have to use the money to pay off their debt. So whether that's credit card debt, whether that's mortgage debt, whatever it is, they have to reduce. So it would either reduce the principal of their debt or it would completely take it away. So therefore, the counterparty would still be made whole. It would reduce the private sector debt. It would free up the balance sheet of the private sector. And to be fair, if someone didn't have any debt, then they're not penalized because they get the 10 grand that they can use for whatever. So if you think about that on paper, I mean, it makes sense, but it's like so many things in economics that if you look at it on paper, mathematically, it should work. But in real life, you got the unintended consequences. You've got, oh my gosh, you go down the list. So the net balance, it might be a negative. And I would argue that it probably would be, just looking at it from my standpoint, which is pure free market economics, capitalism, and kind of from the Austrian standpoint. And kind of the common sense standpoint, but it's not to say that that's not a commonsensical approach from Steve, because I've got a massive amount of respect for Steve, and I'm just an amateur. I mean, he's a pro, he's a professor, so I don't really want to say what I would never say, oh no, Steve, you're wrong. I would just look at that and I'd be concerned that that would have some consequences that might not be obvious when you just look at the math behind the approach. So I think that's the, but anyway, my point is I wanted to get Danielle's opinion on that, because that is a debt jubilee. And you know who else would probably argue for that would be Werner. I don't know that for a fact, and obviously I don't want to put words in his mouth, but I'd be willing to bet $10 that Werner would actually like Keene's approach. But I don't know. So there's different variations of a debt jubilee. The reason Danielle didn't like it is because the version that we talk about most in the United States, the counterparty would get screwed, which would just completely collapse the whole economy. Okay, next question. Jay Kerr, thank you for the super chat. Please comment on tips if inflation is inevitable. Too long of an investment. I think so. And then not only that, you've got to, I mean, what are they basing the tips off of as far as the inflation rate, right? I mean, they're going off the CPI. We know how they pull the tricks there. If you guys have watched my videos on the tax scam of 2018, where, yeah, they dropped the rates, but they changed the way they measure inflation for the tax brackets. Aha. They went from the CCPI to the, I'm sorry, they went from the CPIU to the CCPIU. So what's the difference? The CCPIU measures, the way it measures inflation, it's understated compared to the actual CPI. So, and remember that compounds. So what happens is the tax brackets go up. They adjust a lot slower than the rate of inflation. What that means to you is that a higher percentage of your income over time will go to paying taxes, regardless of what happens to the actual tax rates themselves. It's a massive scam that nobody is. In fact, I'm the only person that I've ever seen talk about this or even point it out. And it's just, it blows me away. I guess no one talks about it. No one even knows about it because they don't read the fine print. And I just happened to stumble across the fine print on the Fed's website when I was doing research on inflation. And there you go. It's right there in plain English. So anyway, my point is, I keep going off on a tangent and saying, my point, bring it back to your question. They're going to give you a faux CPI number. So you're still going to lose purchasing power. That's how I see that. Now, maybe a little bit better than other stuff, but I see kind of the net result being the same. All right, next question. Martin, thank you for the super chat. When will you interview Mike Maloney? Listen, I'd love to interview Mike Maloney and Jim Records. This morning, I was thinking about how I could take a different approach. What's weird is Rickards doesn't have a website. He's got something that looks like it could be his website, but I don't know if it's like a fake website. I don't know. I emailed that the other day. I didn't hear back from him. About 2 months ago, I emailed Mike on his website. Didn't hear back from him. So I've got to take a little different approach. I'm not sure. What I was thinking about today is just reaching out again with another polite email saying, hey, I emailed you a couple months ago. Maybe just would you consider it this time? Or maybe you didn't see it, something like that. I'd love to have you on the show. I'm doing my best because there's no one that would like to see an interview between myself and Mike Maloney more than me. I would love to talk to Mike and Jim Rickards. So if any of you guys know someone who knows Jim or that knows Mike, definitely put in a good word for me, or maybe mention him on Twitter or something like that. Say, Jim, you should go on George Gammon's show. Check it out. Or Mike, you got to go on George Gammon's show. It'd be great. He's getting 1 million views a month. You could promote your product. You could sell books. It would be amazing. It would be awesome. It's the best marketing thing you could possibly do. If you do something, that'll get their attention. But on the upside, Martin, just so you know, I did reach out for a second time to Tom Woods the other day. If you guys are in the libertarian space, of course you know Tom. He's just an icon, and he's one of my favorites. I love Tom Woods. And he actually responded to me on Twitter, and I emailed him. So hopefully he'll have his assistant look at that. And hopefully we'll, even though we're still waiting on Mike and Jim, hopefully next week we'll have an interview with Tom Woods. So that would be a lot of fun. And also I reached out to a couple others who are in the FinTwit space, who you guys will know when they come out. I'll keep it a surprise, we'll say, but I'm going to be interviewing them next week. So we got a lot of fantastic content coming up for the interviews. That's for sure. All right. Next question. John H., thank you for the super chat. How is the stock market able to consistently rise week after week with horrific economic news continue to roll out? Is this a bubble about to pop? Can the Fed keep Can the Fed keep up hopes? John, the first thing you've got to realize is the stock market almost has nothing to do with the fundamentals of the economy. And I know that sounds weird, because aren't the businesses that are listed on the stock exchange just representations of the economy? Before Greenspan, yes. After Greenspan, no. That was kind of when the stock market just completely separated from the real economy. And now, I mean, I think there's an argument, and it's not 100%. It's like it's not like it has nothing to do with the economy, but it has a lot more to do with capital flows. And if you look at Brent Johnson's opinion about the stock market going up, he's not saying, "Hey, the economy is great. America's awesome. We're gonna have he's not touting the Trump narrative that we've got the greatest economy of all time, and as soon as the cerveza sickness is in the rearview mirror, we're gonna go to all-time highs because this economy is booming." That's not Brent's argument. Brent's argument is capital flows. It's that the United States is the cleanest dirty shirt, and if you're a Japanese pension fund or someone in Europe or a sovereign wealth fund, do you want to invest in Japan or do you want to invest in the US? Okay, well, your $50 billion will then go into the US market, not because the fundamentals of the US economy are strong, just because it's the best of the worst. And you, at a certain degree, as long as there's enough capital coming into the market, it's like inflation. It's like inflation with goods and services, right? So what do we have? We have a fixed or a reduced amount of goods and services. If you have a larger quantity of currency units at the same rate or a higher rate of velocity, chasing the same amount or a lower amount of goods and services, prices are going to go up. They're going to go up. It doesn't necessarily mean that demand for those goods and services goes up. So that's a more real life example of what I'm talking about in the stock market, where you've got a fixed number of stocks, but you've got all this capital coming in, all of these currency units chasing the same amount of stocks or goods and services at the same rate of velocity. Stock market goes up regardless of the fundamentals. See, so it's the exact same thing. And that's why we can have a horrific economy and continuing bad news and the stock market go up. It won't last forever, but the market can remain irrational longer than most can remain solvent. So can the Fed keep up hopes? Yeah, it's possible. But I think my main takeaway is that's not a bet I want to make. I don't want to say, oh, well, I see this, we're going to have all these capital flows and the US is the cleanest dirty shirt. Therefore, I want to go long the S&P. No, it doesn't mean that I want to go long the S&P. It just means that I understand the S&P can go a lot higher. And if it does, I know why it's going higher. That doesn't mean that I want 1 penny of my portfolio long the stock market, because it's not cheap. You always have to go back to the fundamentals of why we invest. And regardless of whether it's a speculation or an investment outside of your insurance policy gold, it's got to be cheap. We buy things when they're cheap. We sell them when they're expensive. And there is nothing about the US stock market right now that is cheap. Now, there could be individual stocks, maybe like gold stocks, maybe you could argue maybe Wells Fargo might be cheap. There could be some cheap components, but as a whole, it's wildly overpriced. Okay, next question. Frank, thank you for the super chat. Thank you for the great channel. I appreciate the kind words, Frank. If one believes European banks will fail within the next couple of months, what would be the big short kind of way to profit from this? Well, you'd want to look at options, probably buying puts or selling puts, excuse me. That's pretty sophisticated, Frank. I don't know that I would suggest that. I probably wouldn't even do that myself, but if you're that type of guy, then that's probably how I would look at it. I'd look at pick them, Deutsche. Yeah, but see, Deutsche, you got to look at it from a standpoint of even if they fail, they'll probably be bailed out. But they would go down substantially before they're bailed out. Yeah, I see. I hate to short it because you might want to do it with calls so you can get paid. Nah, but then your upside's not as much. I'd probably just do it with puts on the individuals, but I'd spread it out. Like if you think Deutsche is the worst, don't just do it all with Deutsche because they could bail them out. I'd do like Deutsche, HSBC, the usual suspects there. I might even do HSBC before I do Deutsche, if it were me. But anyway, that's probably how I'd play it, is through options. Okay, next question, Sebastian. Kim, thank you for the super chat. Thank you so much for the hard work to educate people like me who are new to the economy. No problem, Kim. I appreciate it. And of course, I've got to give most of the credit to people like Sebastian, my assistant, who is on the live stream handling business. I've got to give the credit to people like Thomas, to Danny, who are my editors, who make me look a heck of a lot smarter than I really am. That is for sure. And Maria, she's working hard on the website. Jean is working super hard on the website and trying to put together this new product that I've been talking about, Rebel Capitalist Pro, that you guys are just going to absolutely love. You're going to, I cannot wait to roll it out. But I've got to give most of the credit to these people. But we sincerely appreciate the kind words, Kim. And we also get really excited about the fact that people do get value from the videos, and it educates people. Hopefully it makes them more aware of the economic world around them. And if it's doing that, then we're definitely achieving our objectives. So just thank you for the super chat and for just saying that out loud. We appreciate it. All right, next question, Sebastian. Emmanuel, thank you for the super chat. I understand about just asking whether things are cheap or expensive historically. Could you give us some detailed tools on how to do that for analysis ourselves across various asset classes in a video? Yeah, I mean, what I do, honestly, is I just Google a chart. I can't tell you how many times I've gone to my Google URL bar or Google search, whatever, and just typed in historic chart of blank. Historic chart or historical prices, historical chart. Just, I mean, it's almost daily. I'm doing historical chart of adjusted for inflation. It just starts with a Google search and then going to the images and then just diving into it from there. I don't have any access to I don't have a Bloomberg terminal. I don't have access to any special data. It's just Google. That's where I get all my information for my videos as far as charts and data. And then I just really kind of what I do is I consolidate all of the content that I listen to or consume from Macro Voices, Real Vision, and other podcasts and shows like Jeff Snyder's YouTube show that he's doing now with Emil Kalinowski, who's a fantastic guy. Both of them are awesome. Check out their show. It's called Making Sense. It's Eurodollar University on YouTube. But it's really, I just kind of aggregate all that information, kind of think through it, maybe sometimes come to my own conclusions, and then just find the charts to back up what they're saying or back up what I'm thinking, or to better to prove a point or to make it more clear. Then I just kind of use a Google search. But as far as investments, I just start there as well. Let's see, let me make sure could you give some detailed tools? Also, too, from a macro standpoint, I try to listen to as many different opinions as I can, such as the dollar. So I'd not only go and look at a chart of the DXY going back, but I would listen to people who I have a lot of respect for and listen, let's say a bull like Brent Johnson, and I would listen to his argument as thoroughly as I can. I would listen to it to a point where I thought I could explain it almost as well as he can. And then I'd look at a dollar bear like Luke Groman or like Lynn Alden, and I would say, okay, and I'd do the exact same thing. And I would try to understand their point of view to where I could explain it just as well, if not better than they could. And then in my own mind, I would say, okay, I get this. How does it play out? And sometimes I just come to the conclusion of, I don't know. And that's okay. I think that's one of the most powerful things that we can do as an investor is say, I don't know. And it goes back to my interview with Jim Rogers. Remember? So if Jim Rogers does this, we should be doing this, because I can promise you, I'm never gonna be at, well, maybe I won't say that. Maybe I will. Maybe I'll use that as my own personal objective, something to aspire to. Maybe I'll say that, well, as of right now, I'm nowhere near the investor of Jim Rogers. But who knows? Maybe when I'm 60 or 55 years old or 65, maybe I will be as good as Jim Rogers. I'll go ahead and throw it out there. But obviously, currently, I'm nowhere in Jim's category. But my point is, Jim does what? Is his words, not mine, goes back to his interview with Jack Schwager in the late 1980s in the Market Wizards book. Jim says he just sits back and he does nothing. Nothing. He says, I don't know what's going on. I am going to do nothing until I see a pile of money sitting in the corner. And when I see a pile of money sitting in the corner, I get up and I go pick it up. That's how I invest. That requires a lot of humility. It requires patience, and it requires someone who has defeated their ego to a point which they can announce to the world, I don't know. And you'll notice I think the wisest people that we respect are the individuals that you know without them telling you how good they are. While at the same time, they're not afraid to just say, I don't know. Juxtapose that to not all, the majority of the talking heads on CNBC or on FinTwit, where they'll never say, I don't know. Those words will never come out of their mouth. Not only do they know, but they're adamant. They're 100% sure that this is exactly what's going to happen and you should do this. Okay, right. When people start talking about certainties instead of probabilities, you know that you should turn the channel or you should tune them out, or there's someone that's really not worth listening to. Let me go back to the question. Oh, okay. So tools, that's what I do. We looked at the charts. We looked at differing opinions and trying to just assimilate it all in your mind, not being afraid to say, I don't know, going back and learning from the greats like Jim Rogers, read the Market Wizards books, read his books. And other people, not just Jim, but other people like that. And when you understand their framework, and then you can apply that to your own type of strategy and how and what resonates for you, and then you combine all of that into a package, and I think that will give you the tools that you need to know when something is worth considering and when something is cheap or expensive historically. And of course, that's going to be exactly what we're going to do with Rebel Capitalist Pro. That's exactly what we're going to do. That's why I created Rebel Capitalist Pro, so all of us could get together and determine this collectively with the help of some incredible research and incredible charts and incredible experts. But more on that later. All right, next question. Kevin, thank you for the super chat. Am I mistakenly, invested in GLD up to 40%? Oh, yikes. Okay. Do I sell? Okay. Let me try to put this in different words so we're all following, Kevin. I am mistakenly invested, or you might be mistakenly invested in GLD up to 40%. I'm assuming that's 40% of your portfolio in GLD. Hopefully it's just that you're 40% up, but we'll assume it's 40% of your portfolio. Do I sell and pay a large amount of cap gains and buy physical or Sprott? I don't know, Kevin. That is a tough question. It depends on your existing portfolio. I'm going to assume you don't have any physical right now. If you don't have any physical, then I would definitely sell at least enough of the GLD to buy 10% or what equals 10% of your portfolio in physical. Even if I had to take a hit on the cap gains. That's number one. Number two, I would try to get a watch list right now of things that I would like to invest in that could be cheap if we have a second round of the cerveza sickness, or if we have another leg down in the stock market. So let's look at oil stocks. If they get super cheap again, I mean Dutch is still pretty darn cheap, but let's say they go down even more. Let's say if Dutch gets down to 20, then I would consider selling another portion of the GLD, taking the hit on the cap gains, and going into Shell because you're getting it so cheap. And although they cut their dividend over the 3-year, 5-year, most likely that dividend is coming back, in which case you'd be paid to own the stock, and that would compensate you to a certain degree for the hit you've got to take on the cap gains. Ditto that with real estate. Not that I'd buy now, but I'd put it on a watch list. So if you could get something super cheap that's paying you a 10 or 12% return, then it makes up over the long term for the hit on the cap gains. And then I'd try to gradually diversify out of the GLD by selling and going into other assets that are cheap and could pay me to own them. So you're in a better asset, but you're getting that compensation to make up for the hit on the cap gains. And I'm trying to think this through out loud as well as I can. But first and foremost, I would sell at least enough of it to make sure I had 10% of my portfolio in physical. I think that's the best advice I can give you. Well, again, it's not advice for you because I don't know your personal situation, but I think that's what I would do if I was in your shoes. All right, Sebastian, next question, buddy. Ike, thank you for the super chat. Not advertising, but people who are new to gold, silver should check out Jason Burke. Absolutely. You got to check out Burke. Good buddy of mine. The guy just is a diehard researcher. I mean, he's constant. You want to talk about someone that lives and breathes macro. That is Burke for sure. So Wall Street for Main Street is his YouTube channel. Definitely check it out. Check him out on Patreon. He's just fantastic. There's a tremendous amount of value in his research. And you may say it's not an advertisement, but I'm happy to advertise Burke. I think he's fantastic. And anyone that's interested in gold and silver or oil, I think should look at Burke's content on YouTube. And if it's something that you think is right for you, I definitely consider going to his Patreon page. I mean, it's nothing. It's like $5 a month or something. So definitely check out Burke for sure. His point of view has helped me immensely in investigate companies and speculate in gold. Yep, absolutely. Absolutely. and check the BS. You got to do your research yourself. For sure, for sure, for sure. Don't look at Jason or anyone else as far as a research or a newsletter as a way to get quick picks. That's not what you should do. You should just use it as like an employee. Like you should use it as your own personal research assistant. That you're paying them or you're hiring them to give you the research and the information you need to make your own decisions. That's how you should look at anyone who, in my opinion, that's how I would do it. Any of the affiliates I have, or even the Rebel Capitalist Pro product that we're coming out with in 2 weeks, or Burke or anything, I think that's the way you're going to be best served over the long term if you come at it from that perspective. Okay, next question. John, thank you for the super chat. You think there'll have to be more stimulus? Yes. Easiest question of the day, John. Yes, of course there's going to be more stimulus. I think that's, again, no certainties, but I think the probability on that is as close to 100% as I would be willing to go. Reasoning: inflation in T-bill creation. What do you think of holding gold, silver to be able to invest in other assets when cost ratio switches? Yeah, I think it's a fantastic idea. I mean, a lot of people suggest that I've got a lot of respect for. And I don't know that I would do it with a large portion of the portfolio. I would probably do that with the speculative side of my portfolio. But for sure, I think but you do that with everything, not just gold and silver. Like you do that with every asset class, right? You buy it when it's cheap, you sell it when it's expensive, and when you sell it, you look for something to rotate into that's cheap. That's kind of what we want. That's the mindset we want to have with everything, not just gold and silver. Okay, I think that's hopefully I answered that question well, John. A good question, and I totally agree with you. We'll definitely see more stimulus. Okay, Sebastian, next question. Breath of Water. Thank you for the super chat. If Art Berman is right about energy density, should we be considering uranium? Well, again, for the the speculative side of the portfolio, I like it. Back in March, when everything was tanking and falling out of bed, I bought a lot of uranium. Maybe that's something we'll do in the Rebel Capitalist Pro product. I actually haven't thought about that, but maybe that would be neat for the community for me to just share my own personal portfolio, so you guys could see what I'm investing in or invested in, and I have no problem sharing that. Maybe that would be a cool feature. I'll have to think about that. But back in March or whenever the market tanked, I bought a lot of uranium stocks. I didn't have the time to research it, so I had to buy the ETF, which I know Chris McIntosh is going to be angry with me for doing that. But Chris, I just didn't have the time to do it, and I knew it was cheap, so I wanted to buy it, so I bought the ETF. I as soon as I get some time, I promise you, I'll roll out of the ETF and buy the individual companies. But I've made a killing on that play. And again, I don't want to talk. I don't want to speak as though I'm a trader or anything like that, or that you should even consider long or short-term gains, because that's not what it's about. Because I'll hold I might rotate into the uranium stocks, but I'll hold uranium for 10 years. So I don't really pay much attention. But if you want to know, I mean, I'm probably up, I don't know, at least 20-30% on that play. But it's still super cheap, and it's not an investment. It's not going to pay you to own it. But as far as having it in the speculative side of your portfolio, I don't think there's any better speculation than uranium. It's not the only speculation I like, but I think it's It's fantastic. I mean, I own it. If I own it, I would suggest it to my family members and my friends, and therefore that's I'm not going to tell you what to do, but I think you're thinking about it the right way, and I would definitely consider it if I was you, and to the point where I have bought it for my own portfolio. All right, next question. Seymour Truth, thank you for the super chat. Are undervalued cryptos, I don't know if I'd call them undervalued though. There's a difference between undervalued and a price being less than, right? We've got to know what's the Oscar Wilde quote that I used in my video the other day. Everyone knows the price of everything and the value of nothing. So we want to focus on value as well. But with nice fundamentals and real world use cases, a solid speculation for young people as well as silver, I'm stacking both with my unemployment. Yeah, I think if you're young and again, just the speculative side of your portfolio, I think that would be appropriate. Maybe you have some insights that I don't have. I don't really get deep into the cryptos other than just Ripple and kind of your basics, just that and Bitcoin and whatnot. So, but that said, I don't know that I wouldn't have 100% of my speculative portfolio invested in these smaller cryptos, because if you got to say 100 of them, 98 are probably going to go to zero. And so are the two going to make up for the 98? I don't know. That all depends on how that depends on your position size. So, I mean, maybe for a 1 or 2% allocation, so 10% of your speculative side of your portfolio, I would be much more excited about silver than I would the small cryptos. So that's, I think, the best advice I can give to you. And if you're someone young, one thing I want to remind you, the best investment you can make, and you might not be in this position, but just put this on kind of your future game plan or your watch list, and just as a special request from me to you, consider house hacking. Consider house hacking. In the future, consider buying a triplex or a fourplex that's cash flow positive, living in one unit, renting out the others, and then taking the money that you would have used for your rent or your mortgage to invest in more silver and maybe more of the smaller cryptos. But that's the best advice I can give you. Okay, next question. Andres, thank you for the super chat. George, what are your thoughts on this? Okay, 25% gold, silver, got it. 25% stocks. Okay, through the capitalist exploits portfolio. Okay, like that. 25% crypto, 25% real estate, total 100,000. I just think you're over. I wouldn't. I like what you're doing. I love what you're doing. I love the assets, but I just don't like the percentage allocation. So with gold, I don't know. I just like 10%. I mean, if you're 25% gold and silver, you're already at 10% insurance, 10% speculation. And that doesn't include the 25% in crypto. So now let's say you got half and half. Let's say you've got 12.5% in gold and 12.5% in silver. You combine the silver 12.5% with the crypto 25, and now you're up to 37.5% in speculation. See, I don't like that. And then with your 25%, the stocks that you have with Chris, or as maybe based on Chris's research, I mean, are they paying you to own them? And if they're not, then you've only got 25% really in investments, assuming the real estate is paying you to own it. I think, again, I love your thought process. I love what you're investing in. I just don't love the setup of the portfolio and the percentage allocation to the specific asset classes. I would try to restructure this a little bit where you're 10% in gold as the insurance policy, you're 80% in stuff that is paying you to own it, and 10% in a speculation, silver. So what I would do is I take 10% gold. I do like 5% silver, 5% crypto, because that would be my, and then with the 25% stocks and the 25% real estate, then I'd want to make that 80%, assuming that the 25% of the stocks were dividend paying stocks. That's I'd like that a little bit better, just for me personally. Okay, next question. Josh O, thank you for the super chat. Why CF plus rental remain so in the future with money disparity? Why? Oh, I see. Why cash flow positive rental would remain so? It depends on the asset, Josh. So you can't just look at real estate as one big monolith. Are you talking about a $3 million condo in LA, or are you talking about a $100,000 home in Kansas City? Those are different. Those are way, 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 way different. So, and also you've got to understand that as the economy gets worse and we have some income disparity, to your point, or people just not making as much income, they're going to go down the totem pole. Everyone's not going to go from making $100,000 a year to being homeless. That's not going to happen. But the people that are making $100,000 might go down to 50, and the people making 50 might go down to 25, and the people making 300 might go down to 100, or maybe the 300 down to 50. You see, we're not going to have all these people just going homeless instantly. So if you've got a quality property that's at the bottom of the totem pole, even if your current renters can no longer afford your product or your rent, you're going to have, and let's say your renters right now are people making $50,000 a year. Let's say those people can no longer afford it. Well, the people that were making 100 notch down the totem pole, and all of a sudden those are your customers. Or maybe it was the people making 300. Or if the economy gets bad enough, maybe it was the people that were making 500. Now all of a sudden those are your renters. See, so the problem with a $2 million or $3 million condo, even if it's cash flow positive, is that's at the top of the totem pole. So if people go down, now you've got no renters at all. That said, if we go into this deleveraging, like I was talking about earlier in the live stream, over the next 5-10 years, you could see a cultural shift within Americans where they're cramming more people into the same space like they do in South America or parts of Europe. And in which case, then even at the low end of the totem pole, you could have excess supply compared to demand, because it's almost like a population decrease, because you've got more of those people moving into the same square footage. So you have an excess of square footage, what it boils down to. So it's a very nuanced question. And unfortunately, most people that just give this some thought say, well, the economy is going to hell in a hand. What is it? Hell in a handbag? Whatever the saying is. The economy is going to pot, and therefore no one's going to be able to afford rent. And if no one can afford rent, why do I want to be in a rental property? Yeah, I mean, to a certain degree, you're right, but you've got to look at the details of the analysis. And it's not as easy as just kind of a black and white binary type of conclusion. All right, next question, please. E-Money, thank you for the additional super chat. Appreciate it. How challenging is it to buy real estate in your area? Oh, I see. How challenging is it to buy real estate outside of the area where you live? Are good property management companies and maintenance finding tenants? Well, you hit the nail on the head. So that's your big issue, is you got to find good property management and for the maintenance, and hopefully they're doing the tenants for you. If you don't get good property management, you're screwed. It's not going to work. Then I would never, ever, ever suggest doing it. So that's the key. So to give you guys another advertisement, that's why I like Hartman, and not personally. Personally, he's just a good buddy of mine, but that's why I like his service, because you're paying the same price, but he's just taking a commission, or maybe a little. I don't know if he charges a buyer's fee or not, but basically you end up paying the same price pretty much for the same product, but he does all the homework for you, and he pre-screens all of the property management companies for you. And if you buy a product through his service, then he's got what he calls investment counselors. And if you've got a problem with your property manager, calling them up, and they handle it for you to a certain degree. They don't handle everything, but to a certain degree, they handle that for you. So you're not taking as much of a risk with the property management there, but you're looking at it the right way. That is your downside with real estate, especially outside of your area. As far as buying it, that's not that tough. That it is tough to get a super smoking deal, but I mean, again, you can go through Hartman, or even if you don't want to go through Hartman, just look at an area you like. Like Hartman isn't in Kansas City as an example, but just get a great real estate agent in Kansas City. I'm just using KC as an example, just whatever area you like. Get a great real estate agent and let them do the work for you. That's their job. And as long as you know the area well, which isn't tough, go out there for 2 weeks and just drive for dollars. You'll understand where you want to own a rental property and where you don't. That doesn't take years of due diligence. And then let the real estate agent do the work for you. Like if you guys saw some of the first episodes of the Rebel Capitalist show, one of the first people I interviewed was my real estate agent in Kansas City, Christina Brown, who I've used since 2012. And I still use her today. She's absolutely phenomenal. And I've built such a relationship with Christina that I would have no problem buying a $100,000, $150,000 house sight unseen. Just if Christina thinks it's a good deal, bam, wire the money, done. Right now, of course, I'm not doing that right now. I'm being patient. I'm letting the market come to me, everything that I've talked about earlier in the live stream. But if Christina had a deal at 2012 prices right now, and she emailed me, and I'm in Medellin, Colombia, I would have no problem wiring and doing the deal just over the phone, because I know Christina's sharp. And also, she's not going to suggest a property unless she goes out and does video of everything that I would be interested in. So such as the roof, the foundation, the HVAC, looking at the exterior. And now I know the neighborhood so well that she doesn't have to give me info on that. But she knows what I'm concerned with when we're looking at a potential buy. So she just sends me video of all of those things. I look at the video and no problem pulling the trigger. So there's a way to do it, but it takes some effort. And as with anything in life, you got to take. So then you say, well, why don't I just buy stocks? Well, listen, if you're not putting that same type of effort and research into the stocks you're buying, you're going to have problems there too. So you can't go out there and just get a 10% return without doing research. Those days are over. That you could do that in the 1980s, in the 1960s, in the 1970s, and maybe you'll be able to do that again in the United States, but you can't do that now. So answering your question specifically, yes, it could be challenging, but it's doable. It's definitely doable. Okay, next question. Josh, thank you for the super chat. Public bank runs cause real price discovery fast. They do. They do, Josh, but I don't want to turn a short answer into a very long answer, but just kind of be careful with that thinking, because banks don't need deposits today as much as they did in the past. So I think people may see a bank run and say, oh my gosh, that could collapse the whole entire system. Yes, it definitely could. But it's not as big of a deal, although it is huge. I don't want to downplay it. It's not maybe as big of a deal nowadays because of the way money is created and the way the banking system is set up. That, and remember, the banks have a 1.5 trillion plus in excess reserves. I'm talking about the American banks. So I'm not saying I'm a big fan of the banks, and that could change overnight. You know, their balance sheet is heavily weighted assets. So if those assets get devalued, then so does their balance sheet. They could be insolvent very quickly. There's a lot of things that can go wrong, but I would be concerned about a bank run, but I might not be as concerned in the United States as most people are that are concerned about bank runs initially, if that makes any sense. But yeah, it's a great point, Josh. Okay, next question. Courtney, thank you for the super chat. And Sebastian, I know we are going way long here, and we cut off the super chats at like 30 minutes. Can you somehow tell me how many super chats we have left? I don't know if you can maybe email or text me on WhatsApp. Hopefully we're coming to the end here. This is definitely not hour and a half, but let's keep going. I definitely want to power through all of these for sure and do my best. Courtney, thank you for the super chat. And step number one, you're a rock star. A rock star to... Oh, you're a rock star too for insight and education. Thank you very much, Courtney. That's funny. And then Courtney goes on to say, step number two, can't wait to celebrate 1 million subscribers with you. Thank you very much. Step number three, I'm investing in hybrid markets like Jersey, single family versus multifamily. Should I wait if price is 300 grand? Well, I can't answer that question for you, Courtney, because I don't know what your RV ratio is. If you've got a $300,000 single family or multifamily asset and your cash flow or your rents are $3,000 a month, could be interesting, could be worth a look, especially if you're able to purchase it with 30-year fixed rate debt. If your cash or if your rents are $1,500, then you got to wait. That's not a good deal. So it all goes back to understanding the RV ratio, which really is just a way to determine whether or not cash flow is cheap. That's really all an RV ratio is. So as far as your question about single family versus multifamily, I like single family a little bit more, although there's pros and cons to each. The thing I like about single family is it's more liquid. because you've got two sets of buyers. You got an owner occupant and you have an investor, where a multifamily complex or unit, you're only going to have one buyer. That's an investor. That said, if you're going in and trying to house hack, that's different. Then of course I prefer the triplex or the fourplex compared to just a single family home. So that's the best way I can answer that. And it all starts, Courtney, with your RV ratios. Or in other words, you're making sure that you're buying cheap cash flow. Okay, next question. Mr. LV. Okay, we got 3 super chats left. All right. Mr. Lev C, thank you for the super chat. What options does U.S. have to sweep cerveza sickness debt under the rug, aside from inflating it away? What would be the consequence? Well, they could default, but that's basically inflating it away as a default. It's just you're paying it back, but with a lot less purchasing power. So I would consider that a default. But to answer your question specifically, they could just outright default. That would be an option. I think it's just incredibly low probability. They're most likely going to inflate it away or do their best to try to inflate it away. So the consequence of that would be consumer prices increasing in the U.S. domestic economy. Keep in mind, it doesn't necessarily mean that the dollar goes down on the DXY. The dollar could appreciate. The dollar could go to 120 on the DXY while the government was trying to inflate away the debt. Let's think through for a moment why inflating away the debt works. Why does it work? Is it just because we have inflation? No. It's because the government receives more tax revenue. That's why. Theoretically, if we have prices go up, incomes go up, taxable income goes up. Again, maybe not in real terms, but in nominal terms. Therefore, the tax receipts collected by the government increase. They increase relative to the debt. That's why inflation works. It works because tax receipts go up without having to increase tax rates. So if you have domestic inflation, if prices of goods and services are going up, let's say at a 10% clip, that's going to increase the tax receipts going to the government, which makes it easier for them to handle the burden of their current debt load. But it doesn't necessarily mean that the dollars get out into the global economy and reduce the demand for dollars when there's 13 plus trillion of dollar denominated debt outside the US. You've got to compartmentalize your thinking of the dollar and inflation. But to answer your question specifically, the consequence would be consumer price inflation, and it would be a further misallocation of resources that would lead to a far less productive economy moving forward, especially over the long term. And it would also create a lot more, believe it or not, like if it's possible to have more malinvestment than we have now, it would create more malinvestment, and it will most likely create more asset bubbles. Who knows where they'll be? But that they, of course, can deflate in the interim. But it doesn't necessarily have to mean that they'll create more asset bubbles, because if you go back to the 1970s, people forget 1972 to 74, the stock market went down by almost 60% in nominal terms. Huge bear market. While at the same time, the CPI was north of, call it 6-7%. So you had all this consumer price inflation while you had assets completely tanking. So it's I'm just thinking this through, obviously. It's very possible to have asset bubbles, but it's not a foregone conclusion where the misallocation of resources and the malinvestment in other areas, especially in the real economy, would definitely be almost a 100% guarantee, along with the consumer price inflation going up. Okay, next question. Oh, this is the second part of the question, okay? Aside from short-term T-bills, what options do you see ATM to get a cash flow for your cash? What options do you see? Oh, at the moment. Sorry, I'm not up to speed on all the cool kids acronyms and abbreviations yet. So what options do you see at the moment to get cash flow for your cash? Well, I think it goes back to if you can somehow get a super smoking deal in real estate, or I mean coal. That's what I've done, Mr. Lev C, is back in March, I bought some of the coal stocks, even bought an ETF, which have just massive dividends. And not that they won't cut them. I know, I get it. They most likely will in the next year or so. But I'm holding them for the long term. And same thing with the oil stocks. Huge dividends. The other day, I bought, not a lot, but I bought a little bit of Wells Fargo even. And if anybody is negative on the banks, it would be me. Of course, you guys know that from watching my videos. But it got really cheap, and it was paying like an 8-9% dividend yield. So I thought, I mean, it's worth it to me. And again, I didn't invest more money than I was willing just to lose. It was like going to a casino on a Friday night with your buddies and playing blackjack or roulette. You don't want to take out more money than you are comfortable losing. That's just your entertainment fee, right? So that's kind of the way I looked at, not like an entertainment fee, but hey, listen, it's cheap. So there are things out there that are paying good dividends, or most likely will be paying good dividends in 3 years, 5 years, 10 years. And that's kind of what I'd be looking at right now. As far as just your dry powder, that's I like the short-term T-bills. But and maybe you don't do anything. Maybe you just sit back, let the market come to you, but you just start doing the homework and creating a watch list. That's what I'd suggest everyone do right now. Okay, next question. Oh, that is that it, Sebastian? Okay, all right. I guess that's it. Oh, no, 3 of 3. Okay. Aside from Shell, any other good yield stocks you're eyeing? Do you have a video explaining the analysis you do when you invest in a given stock? I don't, but that's a tough video to do because it's very kind of myopic in who it's who would really find value there. It's definitely something we'll include in the Rebel Capitalist Pro product, because part of the Rebel Capitalist Pro is me doing live stream Q&As with people like Lynn Alden, as an example, where we're not only going over her research extensively, but we're also brainstorming on how we personally invest, and then answering investment questions like this. But let's that aside. Yielding stocks. Well, I like coal. KOL. I've bought that myself. I bought a lot of it. It depends on how comfortable you are with the banks. I mean, most people aren't really comfortable. Honestly, I'm not really that comfortable. But there could be some bank stocks that are getting cheap. Definitely, you don't want to look at anything other than the American. They've got the best balance sheets. But again, it's kind of like the cleanest shirt in the laundry hamper. I mean, you've got other oil plays, but I'm assuming you're asking me other than oil. You might want to look at some of the casinos. I know, one I like a lot is Adelson's stock. What is it? It's what is his play there? He owns the Marina Bay Sands. He owns a lot of so Sands Corp, I think, is the name, but it's Sheldon Adelson, and whether you like him or not, that's irrelevant. But he makes most of his money from Macau and Singapore. And I've actually stayed at the Marina Bay Sands many, many times, one of my favorite hotels. And he makes a lot, but he doesn't make that much from Vegas. So moving forward, especially 10, 15 years down the line, I like casinos who are positioned in Asia for sure. So, and I know they pay a decent dividend. So that I might put that on a watch list as well, some of the casinos. And other than that, I don't have my watch list in front of me, so I can't remember, but I'd start there. I think that's the best way I can answer your question. All right, Sebastian, do we have any others, buddy? No more. No, I guess that's it. Okay, guys. Well, thank you very much. Boy, 2.5 hours. Holy cow. That was the longest super chat I have ever done by a wide margin. Okay, well, I sure enjoyed that. Hopefully you guys enjoyed it as well. For those of you who stayed to the end, I really appreciate it. Let me give you guys some shout outs right now. I'm going to look at the live chat. We've got Joe's G's Craft Grow Guides. Thank you. Atlas, thank you. Mr. Jeremy, thank you. Ken R, thank you very much. Adam, thank you. Jay, thank you very much. Same shirt, different day. Thank you. Steve B, Joaquin Cortada, thank you. Stephen Chan, AJ Rodriguez, Eccentric, Zach, Iceman, Krister, Robert, Calvin, Emil, JBW Chen, Da Mayan 5, what was that? I just lost it. OC, Calvin, Ultimate Bargains, Mr. 11th. Oh man, now it's moving too fast. Oh, it's moving too fast now. But I hopefully I got a lot of the names out there, guys. I appreciate you staying until the end. And make sure you check out tomorrow's video. You guys are going to love it. And stay tuned for the Rebel Capitalist Pro. You guys are going to love it. We'll see you on the next video.